You've seen them. The online gurus flashing their brand new six-figure G-Wagons and Range Rovers, bragging about how they're writing the entire thing off on their taxes. It's the ultimate business flex. And if you're a small business owner, a freelancer, or even a W-2 employee with a side hustle, you've probably felt a little left out. You've thought, that's awesome for them, but I can't afford a $100,000 truck. How do I get a piece of that action? But what if I told you there was a simpler, more powerful, and frankly, more accessible loophole hiding in plain sight? One that applies to something you might already own or have been dreaming about. I'm talking about your motorcycle. And what if I told you that the very person you pay to save you money, your accountant, might not even know how it works? They might tell you to use a standard mileage rate, which is wrong. They might get bogged down in rules for cars that don't even apply here. This isn't some shady gray area tactic. This is about understanding the black and white rules straight from the IRS and using them to your advantage. It has nothing to do with your bike weighing 6,000 pounds, and it's definitely not some made-up engine-size rule you read on an internet forum. Stick with me. I'm about to pull back the curtain on the real IRS rule that could let you write off the business portion of your motorcycle's purchase price this year. And I'll break down the 5 best Japanese cruisers that are perfect for the job. And most importantly, I'll reveal the single biggest mistake that will get your deduction instantly denied in an audit. This is the conversation your CPA should be having with you. Your accountant is probably telling you to deduct your motorcycle miles using the standard mileage rate. That's wrong, and it could be costing you thousands. A little-known IRS rule lets you write off the business portion of your bike's price, and it has nothing to do with the vehicle's weight or engine size. In this video, you'll learn the real motorcycle loophole and the critical mistake that gets 99% of these deductions denied. If this is all news to you, hit like, subscribe, and comment log. I'll DM you my free mileage tracker template that turns every mile into cash. Stick around. The number 2 bike on this list paid me $3,600 in year 1 tax savings. Watch to see if it can do the same for you. The problem, the 3 big myths your accountant believes. Before we get to the good stuff, we have to clear out the garbage. The world of vehicle tax deductions is packed with bad information, and motorcycles are where the confusion really gets expensive. Most accountants are pros at W-2s, rental properties, and standard business stuff. But when it comes to the niche rules for 2-wheeled vehicles, they often fall back on what they know: the rules for cars. And that's where the problems start. Here are the 3 big myths that you and maybe even your CPA are falling for. Myth number 1. Just take the standard mileage rate. It's easier. You've heard of the standard mileage rate. For 2025, the IRS set it at a generous 70 cents per mile for cars, vans, and light trucks. It seems simple, but here's the bombshell. It is absolutely unequivocally forbidden by the IRS for motorcycles. You cannot use the standard mileage rate for a motorcycle, period. The IRS's own publications, like Publication 463, make this crystal clear. This is where the bad advice starts. Your accountant might say, track your miles, which is correct, but then tell you to multiply them by that 70-cent rate. That is what's wrong. You still must log business miles, but only to find your business use percentage. You then multiply that percentage against your actual costs, not the standard rate. If your accountant advises you to take the standard mileage rate deduction, they are setting you up to fail an audit. You can't claim the standard mileage rate on a bike, but you still log miles to find your business use percentage, then apply that percentage to actual costs. Myth number 2. You need a 6,000-pound vehicle for a big write-off. This is the G-Wagon rule all over social media. It comes from Section 179 of the tax code, which lets businesses deduct equipment costs up front. For normal passenger cars, Section 179 is kneecapped by luxury auto limits. The famous exception is for vehicles with a gross vehicle weight rating over 6,000 pounds. This is why you see business owners buying giant SUVs and trucks. They can potentially write off a massive chunk of the cost. Naturally, people assume this is the only way to get a big vehicle write-off. Your accountant hears vehicle and immediately asks, how much does it weigh? When you say it's a motorcycle that's maybe 700 pounds, they shut the conversation down. They are completely missing the point. The 6,000-pound rule is a specific exception for certain 4-wheeled vehicles. It has nothing to do with motorcycles, and the fact that a bike doesn't weigh 6,000 pounds is actually why this loophole is so powerful. Myth number 3. There's a special engine size rule for business bikes. This is a myth that just won't die, circulating endlessly in online forums, a classic game of tax advice telephone. Someone somewhere heard that a motorcycle is listed property, and that got twisted into a specific engine size requirement, probably because it sounds technical and official. Let me be your official mythbuster. This rule simply does not exist. I've scoured IRS publications and the tax code. There is no mention of 600cc, 1000cc, or any other engine size when it comes to vehicle deductions. The IRS only cares that you log over 50% business miles, not the bike's displacement. This myth is just a distraction that makes people focus on the wrong thing when buying a bike for business. The real loophole. Okay, now that we've cleared away the myths, let's build the correct strategy. This loophole isn't one single rule, but the powerful intersection of 2 separate IRS rules that create an incredible opportunity for motorcycle owners. It all starts with the method the IRS forces us to use. Since the IRS says we can't use the standard mileage rate, we are required to use the actual expense method. It's exactly what it sounds like. You track and deduct the real-world costs of operating your motorcycle for your business. This is where the opportunity begins. The key is your business use percentage. If you ride 20,000 miles in a year and 16,000 of those are for business, your business use percentage is 80%. That means you can deduct 80% of every single expense related to that bike. Let's look at what that includes. It's way more than just gas. Fuel. Every single fill-up is a deductible expense. Use a dedicated business card or an app like Everlance to track it. Insurance. Your entire motorcycle insurance premium is a deductible expense. A $1,000 annual premium with 80% business use? That's an $800 deduction. Repairs and maintenance. This is a huge one. New tires, oil changes, chain replacements, brake jobs. Every dollar you spend keeping the bike running safely is deductible based on your business use. Riding gear. This one blows people's minds. Safety gear like a helmet, jacket, or gloves used exclusively for your business riding is also deductible at your business use percentage. Loan interest. If you financed your bike, the business portion of the interest on the loan is also deductible. Just take the total interest paid from your year-end 1098 statement and multiply it by your business use percentage. And don't forget the little things. Registration fees, vehicle property taxes, tolls, and parking for business meetings. It all adds up. Just using this method alone will almost always give you a bigger deduction than the mileage rate would have. But this is just the appetizer. Section 179 and the depreciation loophole. This is the core of the strategy. This is the secret sauce. Normally, when a business buys an asset like a vehicle, you have to depreciate it over its useful life, typically 5 years. But passenger cars have extremely restrictive luxury automobile depreciation limits. For 2025, the first-year deduction on a car is capped at a specific amount, often around $12,000 to $20,000. Here's the magic sentence. According to the IRS, those restrictive luxury auto depreciation limits do not apply to motorcycles. Why? Because the tax code defines a passenger automobile as a four-wheeled vehicle. Your motorcycle, by its very nature, is exempt from these caps. This opens the door to Section 179. Section 179 allows a business to treat the cost of an asset as an immediate expense and deduct the business use portion of the purchase price in the year it's put into service. There are two big catches. First, you must use it more than 50% of the time for a qualified business purpose. Second, the deduction cannot exceed your total taxable income from your active business for the year. Any excess amount carries forward to future years. Let's see this in action. Say you're a freelance photographer and you buy a new Honda Shadow for $9,000 to travel to shoots. You keep a detailed log, and at the end of the year, 80% of your miles were for business. Here's how it breaks down. Purchase price, $9,000. Business use percentage, 80%. Deductible basis for Section 179. $9,000 times 80% equals $7,200. Under Section 179, you can take a $7,200 deduction on your tax return this year. If you're in a 30% combined tax bracket, that saves you $2,160 in cold, hard cash. And that's before adding in all your other actual expenses. Just remember, Section 179 can't exceed your business's taxable income for the year. Any unused amount carries forward automatically. If this is already blowing your mind and you're seeing how you can save thousands, do me a huge favor, hit that like button and subscribe. It tells YouTube you're getting value and ensures you won't miss future videos where we break down more strategies the pros don't want you to know. Now, to really make this strategy sing, you want a bike that's reliable, cost-effective, holds its value, and is practical for business. While this works for any motorcycle, Japanese cruisers often hit that sweet spot of affordability and dependability. Here are 5 of the best to turn into your ultimate tax-deductible business machine. Number 1. The Honda Shadow, Aero, or Phantom. There's a reason the Shadow is a legend. It's the definition of a workhorse. Its 750 cubic centimeters V-twin is famously understressed and nearly bulletproof, meaning fewer repair bills. They are incredibly affordable. With an MSRP of $8,700, your initial investment is low. Plus, the shaft drive on many models means no constant chain cleaning, a huge plus for a business vehicle. For pure financial benefit, the Honda Shadow is the undisputed king. Number 2. The Suzuki Boulevard C50. As Suzuki's answer to the Shadow, the Boulevard C50 brings its own perks. Its best feature for a business bike is a super smooth and low-maintenance shaft drive. When you're racking up business miles, the last thing you want is downtime. It also has a comfy, relaxed riding position and big fenders that offer a little more protection on the way to a client meeting. The 805 cubic centimeter engine gives it plenty of highway grunt without sacrificing reliability. Number 3. The Yamaha Bolt R-Spec. Moving up a bit in size, the Bolt is a brilliant choice for urban city traffic commutes. It's big enough to be stable on the freeway, but still nimble enough for city traffic. Its low seat height inspires confidence, and it uses a quiet, clean belt drive, which again keeps maintenance costs down. Think of the Yamaha Bolt as the perfect modern commuter cruiser. It blends clean bobber style with everyday usability. Number 4. The Kawasaki Vulcan 900 Classic. The Vulcan 900 is another metric cruiser powerhouse. It has a reputation for being one of the most comfortable bikes in its class, with floorboards and pullback bars made for all-day riding. Like the Bolt, it uses a clean belt drive. What really sets the Vulcan apart for many is its substantial feel. It looks and feels like a bigger, more expensive bike. It also has a large 5.3-gallon fuel tank, giving you excellent range for a busy day of appointments. Number 5. The Honda Fury. This is the wild card. The Honda Fury looks like a radical custom chopper right from the factory, but underneath that styling is pure Honda engineering, including a proven 1,312 cubic centimeter V-twin and shaft drive. Here's the strategic advantage. The Fury has a custom chopper style desirable amongst many riders, so will hold its value. Imagine writing off a huge chunk of its cost with Section 179 and then selling it for basically what you paid. By now, you're probably pretty excited. The math works, the bikes are cool, but this is the most important part of the video. If you do this wrong, the IRS will not be gentle. Taking a big deduction like this paints a target on your back, and you have to be ready. There are 2 mistakes that will lose you an audit 100% of the time. Mistake number 1, no contemporaneous mileage log. If you only remember one thing, let it be this. You must keep a detailed contemporaneous mileage log. Contemporaneous means you record the trip at or near the time it happens, not 6 months later from memory. Log from a mile away. Your log is your single most important piece of evidence. Without it, your entire deduction is gone. A proper audit-proof log needs 4 things for every business trip. 1. Date of the trip. 2. Total miles driven or start-end odometer readings. 3. Destination, an address or location name. 4. Specific business purpose. Business is not a purpose. Meeting is not a purpose. It needs to be client meeting with John Smith of ABC Corp. Or scouting locations for Johnson wedding photo shoot. Be specific. This sounds like a lot of work, but it's 2025. Apps like Everlance or MileIQ can track this automatically using your phone's GPS. The IRS accepts these digital logs. If you claim a $10,000 deduction without this log, you didn't get a deduction. You got an expensive, interest-accruing loan from the government that they will come to collect. Mistake number 2, falling below the 50% business use threshold. Remember the key that unlocks Section 179. The vehicle must be used more than 50% for business. This isn't just a rule for year 1. You have to maintain it for the asset's entire recovery period, 5 years for a motorcycle. If your business use drops to 50% or less in any of those later years, you'll face something called recapture. Recapture is the IRS taking back the tax benefit you got up front. They'll force you to calculate the difference between the huge Section 179 deduction you took and the much smaller deduction you would have gotten with slow straight-line depreciation. That difference gets added back to your income, creating a sudden nasty tax bill. The lesson is simple. Be honest and be diligent. The less than 50% rule is the bedrock of this strategy. If you can't realistically meet and maintain it, this strategy isn't for you. So let's put it all together. This is the conversation you need to have with your tax professional. 1. Forget the standard mileage rate exists for your motorcycle. You absolutely cannot use it. 2. You must use the actual expense method. You do this by tracking all your miles to find your business use percentage, then applying that percentage to your fuel, insurance, repairs, gear, and loan interest. 3. Use the fact that your motorcycle is not a car to your advantage. This exempts you from luxury auto caps and opens the door for Section 179, letting you potentially write off the entire business portion of the bike in year 1, up to your business's taxable income. And 4, the most critical step, document everything. A detailed contemporaneous mileage log isn't optional. It's your ticket to surviving an audit. This is just one of many advanced tax strategies hiding in plain sight. It's not about cheating the system, it's about knowing the rules of the game better than everyone else. So if this is a strategy you can use, drop log in the comments and I'll DM you my free mileage tracker template. And hit like and subscribe so you don't miss next week's flip, where the bike literally pays for itself. Ride safe, ride smart, and let the IRS fund your next mile.